months of IO on our deal, like 2 weeks before close.
Really? That's what I mean when I say that Freddie can be a little bit of a tougher bag.
We didn't own property in the state.
That's why they did it. I'm sorry. I'm so sick. Hold on. I'm not really sick.
It's interesting to go through this process with whenever my clients are going, hey, let's do Fannie Freddie, right? Do agency stuff, and then just get into because I'll talk to their underwriters for whoever we're using, and then basically go, okay, I know what you want, so I know the list of all the financial information, so we'll send that to them immediately to hurry and get the clock going for those underwriters to get doing their job, and then then you have the environmental and all that comes out afterwards, and you're doing all that to satisfy what they need, and then you have the whole legal part of setting up that the ownership and the GP and LPs and all of the management side of it, right? So there's pieces that you need to put together, and that's why you have good teams of individuals usually on your team, because I know you got some great ones, Nick, and I know I know Drew, you've got a pretty good team put together for your stuff as well, and so and that's the key thing, and then having good good lenders. I will have to say, so Pat Sullivan, you two know real well. So Pat's deal that Billy Joe manages up in Hopkinsville was the very first deal that I did with Trey. It was his very first loan.
It was my first loan.
Yeah.
At Hunt, but it was
first.
As a lender, it was.
Yep.
So. 2 days. It's 2 days into starting at Hunt, we signed the application for Pat's deal, and at Hunt at the time, and I'm pretty sure this carried over throughout my entire time there, it was the fastest someone had ever come on board and signed a loan. And then the day that I started at New Point, I signed a $40 million loan. So my track record is flawless. I have never not been closing as a lender. There's the thing in sales, ABC, always be closing. I have always been closing a loan for 5 years. I've not taken a day off in 5 years. That's the way to put it.
Santos.
So I have a question about the non-recourse versus recourse.
Okay.
So do you pay more fees on the non-recourse loan than recourse?
No, I would say you pay less. But here's, everything comes at some sort of price, right? When you're doing non-recourse financing, what essentially the only way that you can do that is you have to securitize it. You're going to need an investor that's going to bite risk to do that. If you think about what a bank does, a bank takes deposits and they put that money out, and that's their way of doing business. If they run out of deposits, they don't extend any more loans. If they call in more loans, they if they have loans, or their balance sheet is what it is. They operate on deposits alone. In my world, in Fannie and Freddie world, essentially every time you create a loan for Fannie Mae, you're creating a securitized product that goes out to the open marketplace and is sold. It's sold to a Goldman Sachs, a BlackRock, JP Morgan. There's a lot of buyers. In fact, the largest buyer of our paper for 2021 and 2022 was the United States Federal Reserve. So you basically were the largest buyer of our paper. You can feel about that however you want to feel about it. But by securitizing that product, you're going out to an investor, you're taking that product and you're saying, here's your deal. But we also have lower interest rates than conventional products. So you're saying to yourself, how can you have non-recourse financing, which inhibits risk, or which is more inherent risk for the owner of that paper, that securitized product, because they have less access to that money back, and you're still getting less premium. There's a couple answers to that, but one is that the agencies, Fannie and Freddie, act as guarantors of that paper. So they say that if that paper goes bad for any reason, that the collateral can't make whole the investor as from the note that bought the note, the Goldman, the JP Morgan, the agency will. And since the agencies are under conservatorship, who is actually backing that paper is the United States Federal Reserve, the U.S. government. So that's one way that you're able to sell a more technically risky product for less money, is that it's ultimately backed by the United States government. But number two is you have what's called prepay. So you are telling the person that bought the note, the Goldman, the JP Morgan, that their securitized products interest rate is guaranteed through a process called yield maintenance for the remainder of the loan. And not only is the interest guaranteed, but also their investment against the current 10-year treasury versus its fluctuation of up and down is also compensated for, which makes it a decently expensive product to get out of. Well, let's use the right verbiage. It makes it a phenomenally expensive product to get out of on a 10-year note for years 1 through 4. Years 5 through 7, it sort of moderates to where it becomes a little bit more effective, but it's still inexpensive. Years 7 to 10, it becomes a little bit, it becomes more or less de minimis to get out of. But you can hear my voice going. But what we do to combat that, because obviously if you're in sales like me selling a product like that, that doesn't sound so great. What we do is we use two things. You can assume the loan. If you go to sell the product, someone can assume your loan, and you won't have to pay any sort of fee for that to happen. Usually the buyer will pay like a 1% fee, but sometimes you can even get that waived. Number two is we have what's called supplementals. So for some of you that own property now, that maybe have owned it for 3-4 years, you may say to yourself, okay, I think, when I did this, it was worth $3 million. I think today it's worth $4.5 million. I've got $750,000 worth of equity inside of this product or inside of this acquisition. I can stack a supplemental on top of my loan for $750,000 and get that cash back and go utilize that money. I might be running out. You can hear it going downhill. But yeah, so there's a couple different ways to get around that heavy prepay.
I think we got somebody online.
Yeah, Jana, what are the advantages and disadvantages of being a sponsor?
Advantages and disadvantages of being a sponsor.
Yeah, I would say the disadvantage right off the bat is you're signing the note, right? So
signing on to the bad boy clauses.
Exactly. There's non-recourse, or it's non-recourse financing, but we do have what are called bad boy carve-outs, which are essentially features that you can activate in the loan and create it to be a recourse loan. Now, for the vast majority of folks, this is not a problem. It's fraud, essentially, is the biggest carve out. If you sign on to if you don't pay your insurance, if you don't pay your mortgage but you have cash flow to pay your mortgage, if you burn the property down, right? Like there's all kinds of different things that you can do that will activate carve outs to flip the loan from non-recourse to recourse, but we call them bad boy carve outs for a reason. It implies that you did something nefarious to do so. So if you are signing with somebody as a sponsor and you intend to be, like Drew mentioned, a little bit more passive in the operations, one of the risks that you run is that they go out and they burn the property down. So it's still a good idea to evaluate the group that you're in and make sure that everything's good. Another thing is, if you're a sponsor on a deal, let's say that the owner operator doesn't do anything bad, or, the group doesn't do anything bad, the deal just goes bad. If you give that deal back to Fannie Mae or Freddie Mac, it's non-recourse, you're fine, but they are likely never going to lend to you again. So that's important to note. The advantages, I think, are kind of, and I think maybe she's talking about just sponsors that are, intending to be a little bit more passive. There's all kinds of things that you can pick up for doing that. Things like GP percentage that can come to you. Fees can come to you. An expansion of your own personal portfolio can come to you. The opportunity to get involved with other groups that may have more opportunities come to you. There's a lot of
advantages too.
yeah, there's a lot of good things that can come from it. And I know a lot of folks that do it. I mean, they spend a hefty portion of their time evaluating opportunities to get involved with. I would just say that, those folks they intend to provide guidance in the owner operations as well. Like they're not intending to be fully passive.
Yeah, those folks.
Signers.
Yeah, those folks obviously take a lot of time to evaluate the deal. Yeah, but they also evaluate the individuals they're going to be in that deal with, right? Like Trey was saying, right? So and whether you're going to be a limited partner LP into a deal, you want to also know who either the sponsor or the general partners, that kind of deal, right? On that, you want to evaluate them, as well. But from that on the sponsors, but
and as a general partner, you want to evaluate your limited partner.
Yeah. Oh yeah. Yeah. That's somebody we know real well. They'll tell you the story. But let's kind of move forward. So where do rates sit right now with Fannie and Freddie?
Well,
As of like 10 minutes, I'm just kidding.
yeah, no. I mean, most relevant transaction I quoted recently was a 7-year fixed product with 6.5 years of yield maintenance. The spread on that was 175. The 10-year spreads are around 165 to 220. So it's a pretty large spread. There's a lot of things that we do to factor in.
So what does all that mean?
Oh yeah, spread over
75 versus this.
Yeah. So everything's over an index.
Yeah.
The 7 years over the 7-year treasury. The 5-year product is over the 5-year treasury. The 10-year product is over the 10-year treasury. We also have floating rate products. Those are really low. Those spreads can be as low as 115, 110, but those spreads are over SOFR today. So we have a lot of different products that can be utilized with various interest rates. But I would say we are sitting in around high fours to mid fives territory today for various products.
Yeah, I just wanted to bring that up because we Carmel and I had lunch just a couple of days ago with a conventional lender, and he's like, yeah, he goes, agency is just kicking my butt right now.
Yeah. I mean,
because that's one of the things I mentioned at the beginning is that's usually attractive about agency is, you usually get a better percentage on your loan. So
yeah, and our cash flow is better because we amortize over 30 years instead of 20 or 25. When banks say interest only, always laugh. Yeah. It's usually like 6 months, or like we'll really push and give you a year of interest only. Yeah. And we're, we can usually start around 4 years on a 10-year product. We can go all the way up to 10 year. We can do a full term IO product, if things make sense. So there are a lot of bells and whistles to agency financing that make it extremely attractive.
I didn't realize you guys. I thought you were probably around 5. So you're saying you're a little under 5.
There are products definitely under 5. Yeah, I mean, one lowest spread I've seen is 115 over. Yeah. Well, now it's a 475 SOFR, but it was 115 over the 465 SOFR. So no, that's still over 5. Yeah, I'm telling you.
So what? Moving into the next rest of the year. So what's your good friend, pal?
My roll the dice.
Yeah. Your roll the dice. Pal, good buddy. Yeah. Gonna do for us.
Yeah. I
know you predicted and you nailed it a month ago.
I did. Yeah. I was calling I called the 25 pips at the Reigns meeting, but that was before everybody was saying 25 pips. Like a week leading up, everybody's like, it's for sure going to be 25 pips. I was like, 3 weeks ago, every single one of you said it was going to be 50. And, but I knew, like, it makes sense. Like, right before that jobs report came out a couple days ago, and if you don't know what I'm talking about, there was a jobs report came out and said that they had added 515,000 or 570,000 jobs. The expectation was 130,000. So the labor market is ridiculously tight. And I was reading that there are 6 million people who are unemployed. Oh, there is me too. There are 6 million people who are unemployed. For the life of me, I don't know how. There are 11 million jobs available in America right now. So basically for every person who's unemployed, there are 2 jobs available for them. So when that jobs report came out, I'm walking this back now, but pre that jobs report, I genuinely believed that they would not raise the rates again in March. I think they were going to pause, but I think now I'm going to join the camp that says that they're going to raise in March. They're going to raise once more in May, and then I think they're going to take a pause. And I think it's going to be 25. But I watched
But is that already built in?
If that were to happen, I think the 10-year would remain relatively stagnant. I think it's definitely baked in. I think what's now baked in is that they raise it 50 bips. So if they come out in March and raise it 25 bips, then I think that it'll drop 35. The 10-year will drop 35 bips, and it will go back down to where it was pre that jobs report, because that jobs report scared everybody and makes them think they're going to do 50 bips. But here's something. I was a heavy critic of Jay Powell when all this started. I'm still a heavy critic. I think monetary policy has proven over and over again that raising rates does not create deflation. And it certainly, if it does, it certainly does not create it in the short term. And if you don't believe me, I would say go turn on CNBC, because they have risen rates 400 or 500 bips at this point, and we are still in an inflationary environment. We are disinflating, and that's good news. But about 2 Fed meetings ago, I realized something a little bit good about Jay Powell. And what I realized was that
hold on,
I've been a heavy critic of him.
I'll have to go
what I can say is good about him is the man is telling the truth. If he tells you he's going to raise rates, he's going to raise rates. I think we have got to stop not listening to him, because if he has been anything, he has been consistent. He has gone on television time and time again, and he has said we are going to continue to raise rates. And the first clip that comes right after that is Wall Street thinks that the Fed is done raising rates. The Fed is not done raising rates. They are going to raise rates. And as long as they continue to get data like that jobs report, I think that the market will react accordingly. But here's what I also think is happening. I think that we do have a very tight labor market. I think we have a tight labor market because we have a huge demand for product in America. The economy, irrespective of the Fed's ability to try and not make it so, is still very strong, and it's going to continue to grow. There is just no real reason for the American economy to not grow right now. What I hope is happening, and what can happen, is that the jobs reports will continue to be strong, but core inflation will continue to come in. And that will come in because hopefully folks coming online, these 6 million people who, for the love of God, need to go to work and create cheaper eggs, will go and start creating the supply system to get back in line with where demand is at. And we will be able to reconcile the current demand we have because we have a supply that's efficient enough for it. I think we can get there. I think the challenge that I have with the whole rate scenario, and you're going to really start hearing about this in a couple of weeks when it is inevitable that our ridiculous Congress, irrespective of political opinions, is going to have this, again, debate about whether or not they're going to raise the debt ceiling or not. And we're going to start talking about that a lot. And I think what's going to come to light a lot is the sheer amount that we are paying in monthly and yearly debt service on our own debt. Because a lot of what we were talking about when everybody was having the major debt conversations, everybody remembers having the debt conversations of it being $8 trillion. And people remember having the debt conversations of it being $18 trillion. But what a lot of folks don't know is that the current balance sheet of the United States government is $31 trillion in debt. And the debt service on that is phenomenal. And as the Fed raises its rates, it has a negative impact on the United States government to service its own debt. It makes our own debt more expensive. And there's only so much that we can push our own interest rates up before we can't even service our own debt, irrespective of what the debt ceiling is, right? We'll just continue to acquire more debt. So there is a level in which there is no more raising rates. And I think it's probably somewhere around 6%. I'm not smart enough in math to know it, but I've heard people talk about, where it really starts to cap out, and it's somewhere around 6%. And we're really coming into that level close. The only thing that I'm worried about is if we continue to disinflate, it may not be such an issue. But if we don't disinflate and we get to that 6%, there is so much dry powder on the sideline that can come back online. Like the sheer amount of capital that is there but not being deployed right now. Sometimes when you have a recession or you have a depression, you have capital that's gone away, right? The market has lost considerable amounts of value and that money no longer exists. The reality is that the money exists in America right now. They printed trillions and trillions of dollars that went into the money supply and rapidly moved its way up into institutional and high net worth individuals that have buying power behind them that is like immeasurable, but they're not active right now because they see an asset-based recession where things have lost value or could potentially continue to lose value. So they're not buying assets. If we don't disinflate and we are forced to lower rates because we can't service our own debt, then it could become a material problem if all this capital were to come back online once interest rates came down. That's the only major issue I think inside of the capital markets that could really occur, but it's unlikely to.